Welcome to Fomomia! Are you ready to embark on your journey into the exciting world of cryptocurrency trading? Whether you're a complete beginner or looking to sharpen your skills, you've come to the right place. In today's video, we've got a double dose of knowledge lined up for you. First, we'll explore top trading rules for beginners, offering essential tips and strategies to help you navigate the crypto markets with confidence. But that's not all. We'll also delve into the fascinating realm of smart contracts in crypto. These revolutionary blockchain-powered contracts are changing the game, and you'll want to understand how they work and why they matter. So, if you're ready to level up your trading game and gain a deeper understanding of the crypto universe, stick around. Don't forget to hit that subscribe button and ring the notification bell to stay updated with our crypto insights. Let's get started.
Top 5 Trading Rules for Beginners. Trading can be risky and stressful, even in the best of circumstances. Many beginners believe that trading is a get-rich-quick program, but it's really not. But should that discourage you? Definitely not. Rule 1. Know the short-term fundamental news. Most day trading guidelines are based on technical analysis and momentum tactics, which most novices are unfamiliar with. Many individuals also disregard fundamental news and reports linked to and important to the stock or market in which they are trading. Did you know this is one of the most common blunders new traders make since markets are influenced by emotions rather than clear judgment? Short-term fundamental news also hints at what is driving things at any given moment. For example, if a company reports results after the closing bell, it will not trade normally and may have larger swings up or down. Before the opening bell, most experienced traders review economic calendars to ensure they are aware of all relevant variables that may impact the market during the next trading session. Rule 2. Stick to your plan. Traders often begin their days focused and ready to execute their plan according to the guidelines they've established, which is all good. However, when they suffer a few losses or the market fails to perform as expected, things start going south, making them abandon their strategy and begin trading purely on emotions. This is a prescription for catastrophe, my friend, and it happens more often than you may think. Don't allow that to happen to you. Plan ahead of time. Prepare for potential scenarios. When confronted with unanticipated situations, most traders lose their discipline. Prepare for the worst-case scenario, which is losing all of your money in any deal, so you're not caught off guard if or when it occurs. Rule number 3. Avoid market entry late in the day. Entering the market late in the day diminishes the likelihood of deals turning out in your favor since there is just not enough time for them to move. It's not a good idea to open any trades after midday unless you're scalping, which involves holding positions for a short time and taking modest gains every few minutes. Remember, the early bird catches the worm. Sorry if you are not a morning person. Rule number 4. Never enter trades without placing a protective stop. One of the leading reasons for large losses is the failure to employ a stop loss. You've undoubtedly heard this trading tip for beginners 100 times. But do you follow it every time? The issue arises once the input is made. The mind, has a wonderful way of persuading us out of doing things that are beneficial for us. So, as soon as you obtain your entry fill, determine your stop-loss level and put your protective stop order. This trading tip for beginners and experienced alike will become second nature once you practice it a few times. Avoiding stop-loss orders is the most common cause of modest losers ballooning into massive, unmanageable positions. Take small risks and always use stop-loss orders to safeguard your investments. Rule 5. Always perform relative strength analysis. When going to war, it's always a good start to compare your enemy with those you have already beaten. Otherwise, you and I know the results. Relative strength analysis is performed by comparing the instrument under consideration for trading with another that is comparable. For example, if you're trading BTC, you'd compare it against other asset in the market, or financial active, in this case, with USDT. Alternatively, if you want to trade E-mini futures contracts, compare E-mini Nasdaq to E-mini S&P 500 futures contracts. Relative strength tells you how strong or weak the financial instrument you wish to trade is compared to other relevant data. This will provide key signals as to how comparable equities or other markets are doing and critical information about the asset you want to trade. In simpler words, if you're going long to hold some asset, you should choose the strongest one in the market. If you want to sell short, choose the weakest one. Remember that these trading guidelines for beginners provide the basic skills to examine markets and compare the strengths or weaknesses of two linked items.
And I thought you were clever. I'm sorry, but you don't live up to your title. Read a book, smarty. Hi, all. The Intergalactic Crypto Conference continues, and I want to tell you that I'm already ready to become a cryptocurrency scholar. I already know what Bitcoin faucets are, and what cryptocurrency wallets and what smart contracts are, and oops, have I not told you about smart contracts yet? Smart contracts. Why are they smart? It's just an algorithm that doesn't even have a PhD in science. So, where is it smart? My cat can open the food, put it into his bowl, and eat it. He's a smart. Can smart contracts do that? Let's find out. Smart contracts are the computer equivalent of regular contracts, which are not smart. Very often, smart contracts are represented by a computer program running on a blockchain, which performs certain actions when specified agreements are met. For example, you want to sell your plush hedgehog to your best friend. You design a smart contract to suit your terms. What could the terms be? You, as a seller, have to send your friend the hedgehog, and he in turn has to pay for it. First, the friend must reserve the cryptocurrency in a smart contract. Then you must send the hedgehog. Suppose your friend didn't receive the hedgehog or received it in a bad condition. For example, without needless, then the contract is automatically canceled and the cryptocurrency is returned to your friend's wallet. That doesn't sound like a contract at all. And the smart one here is not the program, but the person who wrote it. I guess firstly, we gotta have a little history research to get into the smart contracts fully. Let's see. Smart contracts were first described in the 1990s by Nick Szabo. God, I'm getting tired of calling smart contracts smart contracts. It's too long for a name. What won't they be? Smarties. That's it. Now for the rest of the video, instead of smart contracts, I'm going to say Smarties. Nick Szabo has published several articles on his website regarding the idea of reasonable contracts. His definition is as follows. A smart contract is a set of promises specified in a digital form, including the protocols by which the parties fulfill those promises. Szabo believed that his idea could be applied to various fields related to contractual agreements, loans, payment processing, and the transfer of intellectual property. The last point is actively gaining momentum and is called NFT. There is a separate video about this type of token on our channel. Don't forget to check it out. But at that time, Nick Szabo could not realize the idea due to the lack of necessary technology. And for the first time, Smarties were talked about after the world learned about Bitcoin. One of the main advantages of Smarties is immutability. It is impossible to change a Smarties' conditions and the work process after it has been developed and activated. This means the Smarties are tamper-proof and endowed with the highest degree of security. Since the Smarties are based on blockchain, mainly on the Ethereum blockchain, their source code is available to everyone. This can come in handy in the future, when you can use the Smarties to make big purchases, such as a house. Then you can easily track all previous purchases of that house. Smarties can reduce operating costs. For example, you can buy the same house directly without a relator, exchange money without exchange, or raise money for your project without a crowdfunding platform. Soon, Smarties can be used in different fields: political elections, healthcare, charity, etc. Smart contracts can be developed for a variety of uses. Everything here will be limited only by your own imagination. And that's all for today. The Intergalactic Crypto Conference continues, so subscribe to the Fomomia channel and like it. See you soon!